Seed investors, again, they are typically they have a lot of companies they invest in because it is so hard to pick the winner at the seed stage. You just have very, very low information. Oftentimes you're investing in the people, the PowerPoint concept, and maybe like an MVP, like a minimum viable product or a demo product, right? And so they will do anywhere from 20 to 50 to 60 investments, depending on their fund size. And they are targeting a 100x return pretty much for like every company. I mean, they want every company to be 100x. But the problem at seed is there's a really high failure rate relative to the other stages of venture capital. And so a lot of times it's 2 or 3 companies only that are providing all the return and all the capital back to investors in the seed stage funds. But when they are signing that check and sending you that wire, they are really thinking about a 100x return. Can this be a 100x company? Can this, if they're investing at a $5 million valuation or $10 million valuation, can this be a billion or multi-billion dollar company? Because they also have to factor in all the dilution they and the company will take over the years as they go through different funding rounds. So 100x rule of thumb for seed. They know they're not going to get it on all the deals, even most of the deals. They know they're going to get it on hopefully 1, 2, or 3 of the deals in the portfolio.
Hi everyone, Happy New Year. It's great to see you again. I hope you've had a great holiday, either relaxing or on a fun adventure. In this video, I want to talk a little bit about seed to Series A stage investing and how that transition works and how VCs typically value companies. So this is the last video I'm going to do before my next video, which is really fully on cold food science. And that's going to wrap up a lot of these videos I've been doing on trying to value cold food science. I've published my valuation model on them on Patreon. I did that on New Year's Eve. So if you want to see that, link's in the description. I will talk a little bit more about my price targets in my next video. But really these videos are just talking about how we do valuations from a seed stage. So they mostly apply to cold food science. They'll apply a little bit to agronomics as well. But after this, I'll get into some more videos on portfolio companies, and then I'm going to do a whole series again on agronomics and look at some of the later stage A, B, C, D, where agronomics sits right now. So this is the last, this one and the next one will be my last cold food science specific videos. And then we'll get into portfolio companies and then get into more agronomics videos. For those of you who don't yet know, Cold Food Science updated their website a week or 2 ago, and they're now highlighting their brands. So if you've been following them, probably they look like a traditional VC firm. And as you can see, they have their investments. But actually, if you really look at their company, they're going to be branching out and creating their own food brands. If you've seen their previous website, you'll have seen that there's 3 parts to the business. And I also did an earlier video on this. But essentially they had their investments, then they had their cult food prize, where they give prizes, kind of like the X Prize, to companies who are working in the cellular agriculture space. And then they also had a Cell X, which was really looking at their IP platform and what they're doing. So if you looked at them, a year ago when they first came out, you probably thought, okay, they're just going to be hoarding IP and trying to make a bunch of money off of that. But what they're actually doing is using that IP to build companies, to build the ecosystem, and then to build their own food brands as well. So I think there's a lot more to this company than a lot of people are going to see at first glance. And it's really cool seeing that they're now starting to communicate that with their brands. They're starting with candy and a coffee drink, but I do think that they're going to be getting into a lot more food products as well down the road. So we'll see where this goes, but really this is one of the main reasons why I invested in them, because I just think there's a lot more going on behind the scenes than it might look like. So I'll get into that a little bit more in my next video, But I just wanted to highlight that for people who, might not quite understand this yet. Now I want to spend the last part of this video going over how VC firms should be structuring their portfolios and how they should be working with their companies to bring about the best returns. And I'm not saying that either cult food science or agronomics does this, but I really like this blog. I'll put the link in the description because I think it's just a good way of really operating a VC firm. So I'm not saying, because I don't know, that either cult food science or ergonomics do this, but I would encourage you, if you're looking at investing in these VC firms, to keep this in mind, because this is just kind of a good way to structure finances. It might appear that VCs and founders have entirely opposing goals. Entrepreneurs want the highest possible valuation to maximize the capital raised and minimize the dilution of the founder's equity. What does that mean? Well, if we look at this infographic, if you're just starting a company, you own 100% of the company, and as you start bringing on other founders or investors, you dilute your share in the company over time, which means you own less of the company and you own less control of the company. Investors want to buy the largest possible stake at the lowest possible price. Now, before you jump to conclusions that investors are ruthlessly, singularly interested in buying low, let me make an important clarification. One key goal for a VC, as we see it, is to prepare portfolio companies for their next financing round and work with them on planning and executing those rounds. A great deal of that work starts with setting a present value that will allow founders to raise the next round with a minimum 2x, ideally 3x, bump in valuation. As we can see in the video I did on Vow Foods, it looks like they did a 3x bump in valuation when they moved from their seed to Series A rounds. The way we value a firm at the seed stage is very, very different from Series A on up. In their beginnings, investors value startups almost exclusively by their potential. They look to several factors: the founding team's vision, their ability to execute, the business model and unit economics, the size of the market, the competitive landscape, and so on. This is a lot more art than science. Valuations from Series A, in sharp contrast, take a more analytical approach because there's more to go on. You can run the numbers, look at traction multiples. The team is still hugely important, as are the TAM, business model, and other factors, but investors are likely to arrive at value through some form of calculation. So what is our biggest fear when we fret that a seed valuation is too high? It's that when the time comes, as it must, for that startup to go out and raise a Series A, that the numbers won't add up. That the company cannot support that 2 or 3x increase from its previous valuation, and that this will end in a flat round, a down round, or worse, in no round at all. So there's a few more numbers there, but I think that's a really good way of looking at how seed investors want to work with companies, if they're good seed investors, to actually allow them to grow into their other stages of growth. So that's really important for the next video when we look at the cult food science valuations, because I am basing a lot of my valuation on this ideal scenario as well as the video you just saw with where we want to get to 100x return. We'll see you in the next video.